my friend. How are you?
Great to see you, Greg.
Hey, listen, you are the man of the hour. You're always the man of the hour, but when you take off on a Friday and you think that things are great and bond yields look promising and you've got a 10-year that has been under 4% finally, and then all of a sudden, voila, a war erupts and the mortgage business wakes up on a Monday with a lot of loans floating, having felt really confident. And of course, since then, as you and I talk here very late in the week, it looks like rates have worsened roughly around 70 basis points. What are you seeing, Barry? And are you surprised in the activity as far as rates are concerned? Since we learned of the war, we're now 5-6 days in.
Yeah, over the weekend when this thing started to develop, you want to first watch oil, right? That's the first thing we started watching, and then Monday morning, oil prices started to get off to the races, and as a result, they stoked inflationary fears. So yields started moving upwards. Then we saw a little bit of calm after the president said, "Hey, we can provide insurance for some of these ships as they pass through the Strait of Hormuz. We can also potentially think about naval support." Prices really came back. We lost a little bit of pricing overall, but they really came back. And then over the past, short period of time that we're seeing here, the latest developments, you had a couple of ships actually attacked, and that sent oil prices rising again. So oil prices, as we're discussing this, Greg, we're looking at oil prices that have risen from somewhere around, in the mid 60s to 67, 68 to about $78 as measured by West Texas Intermediate or WTI. So that's a pretty significant rise. The 10-year Treasury yield, which was really flirting with 4%, is now at about 4.13. It's important because right at 4.12, 4.126 to be exact, it's a really important technical ceiling. So I'm watching it here as we're talking. We're kind of battling very close to that area right now. If we can remain above that, that'll be good. Now, of course, there's other things that are coming out, some coincident reports. We got the big jobs report that has to be digested by the markets. There's a chance that thing comes out somewhat bond friendly. But this is all about oil, and this is all about oil's impact on inflation, which the bond market hates inflation. And Greg, we look at what is going on here. For those of you that don't know, the Strait of Hormuz is where 20% of the world's oil flows through. So it's a really big, important choke point. You've got the Persian Gulf, and these ships have to pass through a narrow choke point. It's only 20 miles wide. Now you might think, okay, 20 miles, that's 20 miles, 20 miles. But the channel that the ships can pass through there, it's not 20 miles. It's only 2 miles within that channel that constitutes the shipping lane. These ships don't move very quickly, so it makes them like sitting ducks to drone strikes and land to land missile strikes that they can do. So it's very, very dangerous, and insurance rates have gone up. And this is something that because we can't get the oil out of there, there's a premium for other sources of oil right now, and that's potentially inflationary, and that's why you see rates move up.
And can you tell us how it impacts materials?
It has a big effect on materials, it has a big effect on manufacturing, it has a big effect on transportation. Oil is in everything. So it has so many different areas that it will influence. Now, I looked at historical events to see, while every single event's different, where do we go from here? And Greg, I'll kind of recant some historical events for you here. For example, when Soleimani was killed back in 2020, the event happened January 3rd. Oil was right before the event at $60 a barrel. It moved up to 66 very quickly. So a big move, similar to the move you're seeing here. But then a week later, as things calmed down, it went right back down from 60 to 58. So that was good. Interest rates followed suit almost identically. You saw the 10-year Treasury, and remember back in 2020 where rates were, it was at 1.79, went to 1.89. but then it came all the way back down to 1.81. So that was okay. And then in 2023, the terrible Hamas massacre that occurred caused oil prices to go from 82 to 90. Yields went from 4.7 to 5. And then they came right back down a week later. Oil prices back down from 90 to 83. The 10-year Treasury went from 5 to about 480, but then continued lower. And then one more is just recently back in June with that, Operation Midnight Hammer. Oil went from 65 to 74, so not that different than the move we have here. Came right back down to 67 about a week or so later. Now, I don't know if that happens here. Now, yields the same thing. Went from 436 at that period of time to 446. It was up 10 basis points, similar to what we see here. But then it came all the way back down below where they started, all the way down to 429. So, Greg, if history is a guide and this thing ends quickly, we should have oil prices calm down and a resumption of the strength we saw in the bond market, which puts us back towards around a 4% or maybe lower interest rate on the 10-year. And then you add somewhere around 180, 190 to that. And it tells you that, mortgage rates could dip back below 6%.
Yeah, people really rely on MBS Highway, of course, one of your many companies, for certainty if there is such a thing around rate locks. So we've got tens of millions of dollars in our pipeline right now, as do, you extrapolate that across the industry. There are billions of dollars that are lost in the crosshairs right now. What is MBS Highway? What are you and your crew telling the street right now? Take your losses or hang on?
Well, what we did was we looked at some of the technical indicators, and we actually once we came out of the weekend on Monday, the damage was already done. And from that point in time on Monday, we said, okay, well, we lost like 30 basis points, and we were still at some technical levels that made sense. We said, let's take a wait and see attitude into Tuesday. Now, Tuesday we had a down day. So we're like, oh man, we're kind of sorry we told you to float into Tuesday, but we stayed floating. And sure enough, Wednesday we recovered all and a little bit more of Tuesday. So we were okay on Wednesday. And things were looking good. And then on Thursday, once the attacks on the ships actually came out, we lost about 20 basis points. So we've been telling people to float because we think that the jobs number might be somewhat friendly to the markets, and the technical indicators still look like they're holding on, especially as I mentioned that 4.126 on the 10 years, an important one there. If we're a basis point above it, it doesn't really tell us that that's broken. But so long as that's intact, we think that we've got some interim heartburn, but not long-term damage.
Yeah.
So that's why we're kind of saying let's hang in there. Now, look, this is a developing story, okay? Things can change for the better for oil prices and yields, or they can potentially get worse quickly. That's very hard for us to handicap, Greg. So we can only do what the charts are telling us and what the fundamentals are telling us, which at the present time, we're saying, okay, hang in. Yeah, we lost about 20 basis points from the start in aggregate of where we were, because there's nothing we could have done Monday, right? So we're looking at a potential here to say, if we can stay in that 412, 14 range on the 10-year, let's wait this out. If we start moving above it, then we're going to say, hey, you probably should be switching to a lock-in position.
How do you interpret the behavior of the 10-year? So we're looking at this now. Obviously, it's been heading up since it was around 394, February 27th. Barry, when you look at this chart, like if you're from the outside looking, you're on the outside looking in, this does not look like the bond market expects what's going on to continue to happen or to get a whole lot worse than where it is right now. Am I interpreting that right?
Yeah, well, if you take a look at what you'd seen initially, the damage was already done on the first date that you see there, which I believe Monday. What was that? Monday was was that the 2nd of March? I think so, right? So if Monday was March 2nd, yeah, it was. You see where it spiked up there, and obviously on the 3rd, that was the Tuesday. So we got a little worse Tuesday, but then notice how it came down by the 4th, and things calmed down. And then it was only after on the 5th that they started moving up after the attack. So it looked like things had settled back to where they were, as far as where the damage first happened here. I don't have a way to draw on this. Maybe I do, but if I had the ability to draw on this, Greg, I'd say, okay, you take a look after that initial surge, right? And then you had the secondary surge, but then they came back down to about the same levels. And then to the extreme right, you're starting to see it move up again after the attacks. If things calm down, I think they'll back down towards, somewhere back around 405 on the 10-year, maybe towards 4%. If you look at mortgage-backed securities, they're sitting on the 100-day moving average here. This is important, but that's a good support level. And then on the 10-year, we're looking at this really important level at 4.126. We're battling it right here. If we can kind of hang in there, I think you'll see yields come back down. So that's where we are right now.
Thank you for that illustration, Barry. Any last words for the tens of thousands of originators out there wondering what's next?
Look, I think that this is going to be still going to be a good year, regardless of what happens here. There's reason to believe that inflation is trending a bit lower. We've got a friendlier Fed. Labor market's a little soft. I think you're going to see more activity. I think you're going to see the spread between the 10-year and 30-year fixed rate mortgages continue to shrink. It's a big year for the midterm elections. You're going to see some more initiatives come out. I had a little something to do with some of the things you've already seen happen. There's more. Can't really talk about it, but there's more. I can tell you there's more that we're looking to do. Some that's been tweeted out about. There's other stuff that hasn't. I can tell you that there's some good things happening, I think, that will help us. I believe this will be a good year, so stay optimistic.
Well, the buying, Barry, the bond buying obviously helped. That was a really, really good move. When you say there are things like that, is that what you're talking about? Is that?
Yeah, there's another idea that I presented that I can't really talk about, but you'll know it when you see it. So if it gets there, we're kind of close, but we'll see.
All right, appreciate it. Barry Habib, founder and CEO at MBS Highway and board member at Fannie Mae, and so many other accolades. It would take us probably until Saturday to read them all off. I appreciate your friendship and the impact you continue to make on this industry. Everybody go to MBS Highway. I think there's a 14-day trial on there too, right?
Yes.
Let's go. All right, Barry, talk to you soon, brother. Thank you.